In this video, we're going to compare and contrast McDonald's and Johnson & Johnson. These are two large, well-known international companies, both Dow components, but they have very different business models, and we'll see some of those differences show up in the ratios. McDonald's is a restaurant chain. Most of the restaurants are actually franchises. They have roughly 38,000 McDonald's around the world, and 30,000 plus of those are operated by franchisees who buy a license from McDonald's and typically rent the space as well. So McDonald's owns the land and or the building, and they grant the franchisor a right to operate under the rules specified by McDonald's. They pay McDonald's a portion of the sales. That's where a lot of its revenue comes from. Johnson & Johnson, on the other hand, is in the healthcare supplies business. They operate three major components. One is the healthcare products that they sell to individuals, things like Band-Aid and Neosporin. Those are Johnson & Johnson brand names. They also operate a pharmaceuticals division where they have prescription drugs that you are probably familiar with some of the trade names. And the third is medical devices, where that's where they primarily sell to medical businesses. All right, so they're very different companies. We can look at J&J and see for the last 5 years, their sales are roughly around $70 billion, which makes them almost 3 times the size of McDonald's, which runs about $25 billion in annual revenues. Both companies make a substantial profit, and if we look at the abbreviated cash flow statement, they generate significant free cash flow. Free cash flow is a measure based on the cash flow from operating activities from the cash flow statement minus any money they spend on property, plant, and equipment. That's capital expenditures to maintain or enhance their operating footprint. So that's a commonly used metric out there that similar to net income but different. The net income is based on accounting income. The free cash flow is based on dollar bills in and out of the company. All right. And with these two firms, the numbers are fairly the same in the $4 billion range, free cash flow for McDonald's, and in the $4 billion range for net income. For J&J, the net income ranged from 10 to 16 billion over the 5-year period we're looking at, and the free cash flow was roughly in line with that. With a lot of companies, the free cash flow is going to be materially different than the accounting income, because free cash flow looks at dollars in and out and doesn't include things that are accounting entries but not actual expenditures. All right, moving on to the balance sheet, what we can see here is assets at McDonald's in the $30 billion range, roughly call it $35 billion, although it has been declining a little bit in the most recent year. And with J&J, it's a lot larger than that. It's 4 times plus higher. And when we get into the ratios and the common size statements, we'll see that a lot of that change, a lot of the difference between the two companies has to do with the current assets. The current assets are much, much higher at J&J than they are at McDonald's, but we'll save that for the common size statement. When we look at the liabilities, we see that there's a chunk of long-term debt, and the long-term debt for McDonald's greatly exceeds the short-term liabilities. And it's a little bit more even here with J&J, and they also have a lot of non-current liabilities that aren't otherwise specified. So that's one of those areas that if you really want to understand what these numbers are, anytime you see an other line, you need to go to the 10K and go figure out what is actually incorporated in there. One of the biggest differences, though, has to do with shareholders' equity. Notice that the total shareholders' equity at Johnson & Johnson is roughly equal to the total liabilities. All right, 70 billion-ish, 60 billion-ish, and then it's almost identical for the latest year. So of the $140 billion of assets, 70 billion funded with equity, 70 billion with other people's money or liabilities. We come over here to McDonald's, notice that they have negative shareholders' equity. It's dropped from 15 billion in the 2012-2013. Over the last 3 years, it's dropped to negative 2.2 billion. Negative shareholders' equity is usually not a good thing, but it depends on the reason for it. With McDonald's, it's because they have been buying back a material amount of shares and paying large dividends. They've returned $30 billion to shareholders over the last 3 years, consistent with a financial plan. When you see the treasury stock number get negativer, that means the company's buying back shares and putting them in the treasury. Now, there's a significant amount of stock buyback over here at Johnson & Johnson, but it's just much more excessive over here at McDonald's. And in the end, they have the negative shareholders' equity, but the reason for that is that they're buying back shares of stock. The numbers we record in here for common stock paid in capital reflect the value received by the company when it sold the shares, which might have been 50 years ago. The retained earnings is the earnings they had over the last 50, 60 years, less any of the dividends they pay. The treasury stock, when we see this going up $11 billion this last year, that's the current price that they paid. So the accounting statements are using historical numbers, and that sort of distorts our financial analysis, because finance focuses not on historical values, it focuses on current and future values. If we go down here and look at share price, because anybody that has counted McDonald's out, McDonald's is having their best year ever in 2017, so they're doing okay. If we look at the share price, it's been increasing, and it's been increasing at a faster rate in the last couple of years. If you take the average share price, multiply it by the number of shares outstanding, you get market capitalization. And market cap reflects the market value of the existing equity. Share price is a forward-looking number. It looks like at what the company is going to do in the future, as opposed to things like retained earnings, which reflect things that have happened in the past. And we see, based on the market capitalization numbers, that at least investors have greater confidence that McDonald's is going to do well going forward. That remains to be seen, but it does illustrate some of the difficulties we're going to have in making comparisons between McDonald's and other firms, because it really is unusual for a large firm like McDonald's to have negative shareholders' equity and yet be a strong going concern operation.